Hello, everybody. This is Patrick MontesDeOca with the Equity Management Academy weekend podcast report for the gold market for January the 23rd, 2021. Gold and silver prices on Friday posted moderate losses on strength in the dollar. Silver prices on Friday also retreated after Germany cut its GDP estimates for this year, which signals reduced industrial metals demand. Losses in gold were contained as a slide in stocks boosted the safe haven demand for gold. Silver prices also recovered from their worst levels Friday on better than expected U.S. economic data. Friday's U.S. economic data was bearish for gold but positive for industrial metals demand and silver prices. The U.S. Jan market manufacturing PMI unexpectedly rose plus 2.0 to 59.1, stronger than expectations of minus 0.6 to 56.5, and the fastest pace of expansion since the data series began in 2007. Also, December existing home sales unexpectedly rose plus 0.7% to 6.76 million, stronger than expectations of a decline to 6.56 million. The action by the German government on Friday to cut its economic forecast for this year was supportive for gold but negative for industrial metals demand and silver prices. Germany cut its 2021 GDP estimate to 3% from 4.4% projected in October, citing extended lockdown in place to slow the spread of COVID. Comments today from ECB Governing Council member VCPMI were negative for gold when he said the balance of risks is still on the negative side, but there are signs that could turn the balance of risks to neutral. Slack consumer price pressures in Japan are negative for gold demand as a hedge against inflation after Japan's national CPI ex fresh food and energy fell minus 4% year to year, the fastest pace of decline in 7.5 years. Gold has supported from the worsening COVID pandemic, which is dovish for central bank policies. However, the pandemic is forcing countries to tighten their lockdowns, which is negative for economic growth and industrial metals demand and bearish for silver prices. President Biden warned late Thursday that the pandemic would worsen before it improves in the U.S. Dark winter, where another 100,000 U.S. COVID deaths are expected over the next month. Globally, COVID infections have risen above 98,204 million, and deaths have exceeded 2.103 million. Safe haven demand and dovish central bank expectations have sparked fund buying of precious metals in recent months. Long silver positions in ETFs rose to a record high Thursday of 912,058 million troy ounces, data from 1990. However, long liquidation has set in gold after long positions in ETFs fell to a 5 3/4 month low on December 22nd, down from October record high of 3,429 or 3,459.8 metric tons, data since 2008. The big picture in gold, silver market factors. Bullish factor include 1. Highly stimulative monetary policies by the world's central key banks to prevent systemic stress in the global financial system and combat the economic damage from the COVID pandemic. 2. The recent sell-off in the dollar index to a 2 3/4 year low. 3. Low global inflation that is dovish for central bank policies. 4. Fund and retail buying on precious metals with long gold and long silver positions in ETF near or at record highs. And 5. Safe haven demand due to the COVID pandemic, trade tensions, and global geopolitical risks involving Iran, North Korea, and Venezuela. Bearish factors include 1. Bearish fears of long-term deflation due to the massive economic damage from the pandemic. 2. sharply reduced industrial metals demand, including for silver, due to the pandemic and the weak global economy. 3. The recent surge in Treasury note yields to a 10-month high, which encourages investors to move out of non-interest bearing metals into better yielding government debt. 4. Recent optimism that COVID vaccine will spur on economic recovery, which has sparked long liquidation in gold. And 5. Record high stock prices, which curbs the safe haven demand for gold and silver. As we take a look at the gold market prospective outlook as we come into next week, I want to put into perspective, first of all, the fundamental analysis that I just mentioned. And if we take a look at the actual market reflecting those fundamentals, what we see here is that, first of all, the close on Friday was at $1855.50. Closed down about $10.40. And after coming down to test the 1800 low, the market reverted right back up to test the high end of this pattern into that 1874.60 level. Now, this correction that took place here from the high of 1960 was essentially confirming that the weekly, the monthly targets were completed. And after reverting from this correction, a high of 1960.50, the market came down from January the 6th to the 19th to a low of 1800. That's about $162 correction since this high was established at 1962. That seems to be the ceiling of resistance, as you see here, going back to the highs that we made on January the 9th at 1966. The high that we made on August 7th at 2089 completed this previous pattern that essentially began around March of last year, around the 1450-51 low. And this was the beginning of the pandemic. Not knowing basically the damage that was expected, the gold market discounted in rally to 2089 on the face of basically the Feds coming in, confirming into the market that they will produce as much stimulus, support, quantitative easing as necessary. And according to some comments made by the governor, the Fed Governor Bullard, a couple of weeks ago, in an interview, he commented that back in March, the Feds and the Treasury had discounted already about 10% of GDP to be allocated to support the markets against any potential systemic risk or collapse. We're talking about $24 trillion that is on the table that essentially is ready to be implemented as stimulus. And so it is a staggering amount, obviously. And the gold market seemed to have discounted now this potential damage that was done and reverted back, adjusted its value back to the mean, and went even below the mean to test the bigger patterns of the annual signals that essentially confirmed where the buy-in interest was identified, where the strong hands was identified. And so we established a low last year at 1767, 68, in that vicinity, which was pretty close to the 50% Fibonacci retracement that essentially we had in place from the low that was made back in March to the recent high that we saw here of 2089. And established the annual low for the 2020 period. Identifying the annual average price back in September gave us an idea of that this low is going to be tested, possibly, potentially. It was active, and upon completion and testing of this low back in November, the market reverted right back up and activated an annual bullish trend momentum. The annual bullish trend momentum activates the yearly prices of 2164 to 2242. Now, if we take a look at the shorter term window, or if we take a look at the monthly, we can see that the monthly buy one level of 1816 comes very close to that 1810 level. Very close to it, and that is what we have identified as a harmonic alignment, which gives us an extremely high probability that if the price comes down to these levels here, we can expect a reversion to unfold. And once the reversion unfolds, the targets above are activated. And here we can see the yearly signal being activated, and automatically the monthly signal was activated as well, and the target of 1950 was completed. Prospectively, when the market gave the signal, we had the monthly, or the bigger picture, so to speak, in place. That identifies the extreme levels above the mean, short-term, intermediate, long-term, and cyclically, as we see on the chart here, that we have pretty much combined the monthly, the annual, and also the 9-year cycle of 1675, which is the average for the 9-year cycle. So as we come into next week, based on the close on Friday, first of all, if we take a look at the market, monthly average is 1864. The market closing below that monthly average is at 1855 is bearish. It's giving you a bearish trend momentum on a monthly basis. And this bearish trend momentum has once again activated the 1816 to 1810 prices. Unless it's negated and it closes above 1864, which negates this previous bearish pattern to neutral, and a close above it activates the targets above that we're looking at, the 1950 level on the monthly sell one target. So we seem to be testing the lower end of the monthly and the 360-day averages. If we take a look at the chart here, you can see the Fibonacci fans that we use as well in conjunction with the VCPMI algorithm, simply to identify and validate and confirm the momentum of the market and its extremes. And so, looking at this, it appears that even though we have a bit of an ambiguous signal as we come in with a monthly bearish trend momentum, but we have activated a monthly an annual bullish trend momentum that has in place the first target of 2164. And in between that range, then we can take a look at the monthly numbers that indicate a close above 1864 is going to negate this bearishness and activate the bullish trend momentum, activating the targets above of 1950 to 1998. If we go back to the shorter term signals, we can clearly see where the market is in relation to the daily and the weekly. And so as we come into next week, the market closing above the daily average of 1854 is bullish, activating the monthly target of 1864, which is the nearest target. But the daily targets as we come into next week's are 1872 to 1888, as well as the close above 1864 on the monthly will activate the bigger picture, the higher numbers. But in between we have the weekly sell target of 1887 to 1918. And what we want to do is basically recommend to use these pivot points as targets for you to lock in your trading ranges, regardless of the fundamentals of the market. Strategy. As we come into next week, if we take into account the fundamentals of the market, which are extremely bullish for the price of gold, it appears that the market is not really reacting to those fundamentals. It looks like it may be looking for some additional support in order to ignite and accelerate these levels into that 2100 area as projected by the annual targets. In the meantime, short term, as we take a look at the action as we come into next week, we want to see the price action trade 1864 or higher and complete the targets of 1872, ideally to 1888, which is the harmonic alignment that I'm looking at for next week that is telling me this is going to be a critical level. If you are long, this might be an area where you want to manage your profits at this point. And based upon your profile, obviously, you can use this indication either to delta neutralize your position, to hedge, or to synthetically cover your position. If the market comes down below 1844, 1854 would be the daily, but 1844 would be the weekly. Upon testing the 1864 and coming down below this daily and weekly averages now, increases the probability that the market may test once again the lower end of this support level, that as we come in on Monday, it's 1838 to 1820, and right below 1820, we're looking again at the weekly pi 1 of 1813 to 1770. And the levels of 1820 to 1813 offer for us the harmonic relationship that we're looking for in order to get on the long side of the market. To review, the market is coming in with a bullish trend momentum, weekly, daily, and a close above the monthly average of 1864 is going to accelerate the targets of 1872 to 1888, at which point I would recommend for you to lock in profits for the time being, and then let the market trade the supply and demand function up here and see where it wants to go. Above 1887, above 1888, we have the second target level of 1918, but we begin to see a very large area of distribution of supply that potentially can be attractive for sellers to come in on this price range and offer supply if activated.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit EMA2trade.com for more details. Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit EMA2trade.com for more details.